I want to welcome all of you to the Memorial Day edition of BUS 621. Tonight we're going to talk about stockholders' equity. Now, to put this in perspective, tonight we're going to talk about the accounting for and the presentation of stockholders' equity. In 622, we're actually going to calculate the cost of stockholders' equity. All right, now, the financial information we're talking about and the financial information that you're going to use for your projects assumes a corporate form of business organization. There are others. There's partnerships and sole proprietorships, limited liability companies, limited liability partnerships. But we're assuming a corporate form of business organization. Now, with the corporate form of business organization, the ownership portion of the business is broken into two accounts, or two accounts, if you will, or two parts. The first is contributed capital, where the company, through an underwriter, goes out and offers shares of stock to individuals who purchase the stock, and under this type of transaction, the corporation actually receives the money. Later on, if a stockholder decides they no longer want to hold the stock, they would sell it on the open market, but then they'd have to go through a broker and trade the stock on an exchange. But the transactions we're talking about tonight are where the company goes out and, again, through an investment bank or through an underwriter, issues stock to outsiders. The second part of stockholders' equity is retained earnings. And retained earnings are all the earnings that a company has earned since its inception, less anything that has been paid out to the stockholders. And this payment to the stockholders is in the form of dividends. Now, the reason that corporations have to break the ownership into these two sections, if you will, is that they cannot pay a dividend unless they have positive retained earnings. Okay. Okay, now, again, what we're dealing with are publicly owned corporations. For your projects, you're choosing companies that trade on the exchanges. And individuals or mutual funds buy stock in these corporations. You can have closely held corporations, but closely held corporations are not offered to the general public, and a closely held corporation could be owned by as few as one person or a handful of people. But we're dealing with publicly owned corporations. Now, in the U.S., you incorporate by choosing a state that you want to incorporate in. And a corporation is treated as if it were a citizen of the state. Okay? And because of that, because it's treated as an individual, it is taxed, and it also has other benefits such as unlimited liability, which we'll talk about at the end of the lecture. Okay, so not every state has the same type of laws. Okay, so that's why a corporation may choose to incorporate in a state other than the state it actually conducts its business. Okay, now, forming a corporation does require the help of a lawyer, okay? You have to file articles of incorporation with the Department of State in the state that you're in. And then there's going to be, if you're a public corporation and this is the first time you've incorporated and you're going to issue stock, there's stock issue costs, attorney's fees, accountant fees. So these are the organization costs. Okay. Okay. Now, when you incorporate, and by the way, what I'm talking about tonight will help you not only with the Go Live program exercise, which all of you will have to turn in since we're not meeting for class, but also the definitions that are in Connect. So when you file your articles of incorporation, you ask permission from the state to issue a specific number of shares. And those shares are called authorized shares. All right? Now, there's a distinction. Authorized is you're telling the state these are the maximum number of shares that I want to issue. When you issue shares to the people in the public, the general public, those are called outstanding shares. No, are called issued shares. All right? And later on, we're going to talk about treasury stock, and we're also going to talk about the way you present equity, stockholders' equity on the balance sheet. And one of the things that you have to indicate is the number of shares authorized, the number of shares issued, and we're also going to learn tonight about outstanding shares. And issued shares are shares that have been sold to the public. Outstanding shares are shares that are still in the hands of the public. The difference is treasury stock. And before we finish tonight, I'll tell you what treasury stock is. All right, now, I'm going to distinguish two things here. When stock is sold, it's sold at a price, and what you'll learn in 622 is that the price of a share of stock is equal to what investors feel is the present value of the future earnings of the stock. And future earnings could either take the form of dividends or of stock appreciation. Okay, now the reason I'm making a big deal of this is, first of all, when we do 622, we'll be very interested in the market value of shares of stock. Okay, but I want to distinguish market value from par value. And par value we're going to talk about in a second. But again, market value is what the stock sells for, and it's based on what investors feel is the present value of the future earnings stream. All right, now par value is an arbitrary amount that is assigned to a share of stock and is indicated in your articles of incorporation. Par value or stated value was never meant to be a surrogate for market value. At the time of the Industrial Revolution, when corporations began to be created, in the United States, information traveled very slowly. And what the state governments wanted to do was to ensure that if someone created a corporation, the owners put in some minimum amount of capital and left it there. And this was done to protect the creditors. All right, now in today's information age, financial news travels in real time. So the likelihood that someone would start a corporation, borrow a lot of money, and then leave town is not as likely as it was back in the 1700s, the 1800s, and the early 1900s. But par value still remains. And par value is what we use to record the values that go in the stock accounts themselves. And you'll see that in a few minutes. All right, so when we issue stock, and here's the reason I made a big deal between market value and par value. What this is saying is that we're selling stock that has a $2 par value, and we're selling it for $8 a share. Now, the $2 par value was the arbitrary amount assigned to the stock when the articles of incorporation were filed. The actual value of the stock, based on what investors feel the stock is worth, is $8 a share. So we're issuing 10,000 shares at $8 a share, so cash goes up $80,000. The capital stock account is increased for the par value, $2 times 10,000 shares, and the remainder of the proceeds goes into an account called additional paid-in capital. All right, now again, as I indicated, when you present stockholders' equity on the balance sheet, you have to say capital stock, $2 par value, authorized, I believe it's 50,000 shares, issued and outstanding 10,000. That is required information. And when you're doing your projects and you look at the balance sheet of your projects, that's the stockholders' equity account. The presentation should be in this format. The additional paid-in capital is what was paid in excess of par. So once you list your paid-in capital, then you show retained earnings. All right, now some states do allow no par stock. Okay. Again, I said not every state has the same incorporation requirements. Okay. So when this no par stock is issued, the entire issue price is credited to the capital stock account and is viewed as legal capital, not subject to withdrawal. So again, the reason for the par value is to ensure that creators of corporations put in some minimal amount of capital. With no par stock, the whole thing is assumed to be legal capital and cannot be withdrawn. Okay, now with common stock, the common stockholders are the owners of the corporation. They're entitled to vote on the slate of directors that is put up. The board of directors theoretically represents the stockholders. They're allowed to participate in dividends based on their percentage of ownership. And in the event that the company goes out of business, the liabilities or the assets will be converted to cash, the liabilities will be paid, and then whatever is left will go to the common stockholders based on their percentage of ownership. All right, now, there's also a preferred stock. Now, later on, if not in this 621, in 622, we talk about companies issuing bonds. And bonds, basically bonds promise to pay a certain amount of interest, and they promise to pay, they promise to return the investment back to the creditor at the end of the bond's life. Common stock doesn't really promise anything, although we're going to learn that you have to make your common stockholders happy by either paying them dividends or having the stock appreciate. Preferred stock is in the middle. It's similar to bonds in that it promises a certain percentage of dividend, but unlike bonds, preferred stock is not redeemed. It's similar to common stock in that regard. The reason it's called preferred is that the preferred stockholders would get their dividend before the common stockholders got theirs, and if the company liquidated, the preferred stockholders would get their money before the common stockholders do. Now, again, I said that preferred stock promises a dividend. However, if a dividend is not declared, then the preferred stockholder would not get a dividend in that year. Now, there's preferred stock can either be issued cumulative or non-cumulative. Now, there's a couple of homework problems on this, so pay attention. All right. Cumulative preferred stock means that you must pay all the dividends that you missed plus the current year dividend before the common stockholder can get a dividend. Okay? Now, and again, the presentation on the balance sheet, the preferred common stock at par would be shown first. Again, you'd have to disclose the authorized shares and the issued and outstanding, and then you would show your common stock at par, and then the additional paid-in capital accounts. Now, a dividend is a distribution of cash back to the shareholders, okay? And again, if a dividend is declared, the preferred stockholder would get their dividend first, and then the common stockholders would get their dividend. All right, so again, I said the cumulative feature simply means that if a dividend is not declared in a year or 2 years or more, the preferred stockholder, and then finally a dividend is declared, the preferred stockholder must get all years unpaid dividends plus the current year before the common stockholder will get theirs. Now, they're going to give an example. It says, assume that a corporation is organized on January 2016 with 10,000 shares of $8 preferred common stock. And then they're giving us two scenarios. If the dividend is non-cumulative or if the dividend is cumulative. All right? So if assume that the $8 preferred dividend is paid in 2016, a partial dividend of $2 per share is paid on the preferred stock in 2017, and no preferred dividend is paid in 2018. Okay? Now, if the dividend of $100,000 is paid in 2016, all right, what would happen is the preferred stockholders would just get their current year dividend, and in the second year, they would just get the 20,000 and that would be that. Okay? If the stock is cumulative, they would get the 80,000 for 2016. They'd get 20,000 in 2017, but if a dividend is declared in 2018, they have to get the 60,000 to make up the 80,000, and then they get their the full dividend in 2018. Okay. All right, so dividend in arrears are not included in the liabilities on a corporation's balance sheet. However, dividends in arrears should be disclosed in financial statement footnotes. And they give us an example. It says, as of December 31st, dividends on $8 cumulative preferred stock were in arrears to the extent of $14 per share, and it amounted to $140,000. Okay. Okay, now this is a quick overview then. If we look at the equity portion of the balance sheet, the way it's presented is the preferred stock at par, and then the additional paid-in capital is separate. The common stock at par, and then the additional paid-in capital is separate, and then retained earnings. Okay, now, we're doing the statement of cash flows as a separate chapter later on. But kind of as a preparation for that, when we issue common stock, it's disclosed in the financing section. When we retire common stock or treasury stock, it's disclosed in the financing section. And when we pay dividends to our own stockholders, it also shows up in the financing section. Okay, so again, I'm paying a lot of attention to market value, and simply market value is the price that stockholders are currently paying for our stock. Okay, and they're pointing out that market value has no correlation to par value, and it could change from what we originally paid or the book value of a share of stock. Okay. Now, your homework deals with recording the issuance of stock. Okay. Or the retirement of stock. All right, so now a stock split occurs when or a company feels that its stock should trade within a certain trading range. And when it gets beyond that, the feeling of the company, and this is a company-specific thought, if it gets beyond that, it becomes too expensive, and consequently, people don't buy it. I hope this is a good example. In other words, I would love to drive a Mercedes-Benz, but I can't afford it. So I admire the vehicle, but I don't buy it. Okay, well, the least expensive way to buy stock is in 100 share blocks. Right now, I think Google or Facebook are trading at around $400 plus a share. So if I wanted to buy 100 shares of Google, it would cost me $40,000. Not a lot of people have that kind of cash lying around. In fact, I'm surprised that Google and Facebook haven't split. So what a stock split does, in other words, a 2-for-1 stock split. Let's say your stock had a $100 par value, and you had 100,000 shares outstanding. If you did a 2-for-1 split, you'd now have 200,000 shares outstanding, and the par value would be cut in half from $10 to $5. All right, and theoretically, if the stock was selling for $400 a share after the split, it would theoretically sell at $200 a share. And again, the whole idea here is to bring the share price down to a more affordable level. Okay. All right, now here's an example, but I'll blow by that. All right, now treasury stock is where the company goes out and repurchases their own shares of stock. Now, why would they do that? Well, if I have an incentive compensation plan that allows my employees to buy, if I give my employees options to buy stock, if they choose to exercise the option and buy the stock, I have to have the stock available to sell to them. If I'm involved in a merger where I'm going to exchange my shares of stock, my company's shares, for the shares of the acquired company, I have to have the shares available to do it. If you're listed on a public exchange, you have to keep your earnings and your share price, your earnings per share and your share price above a certain level. And when these benchmarks start to slide, one of the things that companies can do to increase earnings per share and increase the stock price is to simply remove shares from the marketplace. And the other reason companies buy their own stock is to prevent a hostile takeover. All right, so now treasury stock does not receive dividends, it does not vote for the directors, and does not share in the assets upon dissolution. When we go out and we purchase treasury stock, we record it for what we pay for. Okay, so par value does not come into play here. So here we're reacquiring 1,600 shares of $5 par value stock for $90,000. So the entry is to simply debit treasury stock for $144,000 and credit cash. The par value, again, does not come into play here. Treasury stock is called a contra equity account. And as such, if you look at the presentation of stockholders' equity, it's reported below retained earnings, but at a negative amount. All right, let's see, contra equity. All right, and again, I said that on the face of the balance sheet, you have to indicate the shares authorized, the shares issued, and the shares outstanding. And the difference between issued and outstanding would be treasury stock. Okay, and again, if I were presenting the stockholders' equity portion, I would have my paid-in capital at par and the additional paid-in capital, then retained earnings, and then I would subtract the treasury stock to arrive at total stockholders' equity. All right, now, when you reissue treasury stock for more than what you paid for it, you do not record a gain. All right, you don't record income. You simply increase cash for the total amount of the transaction. You decrease treasury stock by the shares sold times what you paid for the treasury stock, and the difference goes into additional paid-in capital. Okay. All right. Now, should you sell the treasury stock for less than you bought it for, uh, then you would decrease additional paid-in capital. Okay, so no gain or loss is recognized. Okay. All right, now, one of the homework questions deals with book value. And this is the only reason I'm covering this. Because book value, first of all, book value is computed, and what this says is if a company has both preferred and common stock outstanding, computation of book value per share requires, it's a two-step process. The amount assigned to preferred stock and any dividends in arrears is deducted from stockholders' equity. Okay, that's step one. And then the remainder of stockholders' equity is divided by the number of shares outstanding to get book value per share. Now, the only reason I'm bringing this up is this is one of the questions that is in Connect. All right, and again, the market price per share of stock is based on what investors feel is the present value of both the dividend payments and the stock appreciation. Now, I'm addressing these because this will help you with the Connect homework. All right, the biggest advantage of the corporate form of business is unlimited liability. If I'm a stockholder in a corporation, no, I said that wrong. The biggest advantage of the corporation is limited liability. If I'm an investor in a corporation and the corporation is sued, the most I can lose is my investment. Now, you're probably saying, well, you're losing your investment. Why is that an advantage? With a sole proprietorship and a partnership, if those types of organizations are sued, the plaintiff can not only go after the assets of the business, they can go after the personal assets of the sole proprietor and the partners. All right, now it's this issue that gave rise to the creation of limited liability companies and limited liability partnerships. But we're only focusing on corporations. So again, the biggest advantage of a corporation is limited liability. The other thing it does is it allows for transfer of ownership. And this is a tax planning for estate planning. If I'm the owner of a corporation and I would like to have my children take over the corporation, I can begin to gift them shares of stock. So what it results in is a tax-free transfer of ownership. You cannot do that with partnerships and sole proprietorships. Also, with corporations, if you're a public corporation, I can be an owner in General Motors, but I don't have to worry about running the business. Continuity of existence, if I had shares of stock in a publicly traded company and I died, the stock would simply go to my beneficiaries and the company would continue to march on. All right, now, the biggest disadvantage of the corporate form of business is this concept called double taxation. Dividends are paid out of net income after taxes. So income has already been taxed inside the corporation. If I declare a dividend and the stockholder receives the dividend, they are also taxed on a personal basis for the dividends that they receive. So biggest advantage, limited liability. Biggest disadvantage, double taxation. Now with corporations, especially publicly traded corporations, there's greater regulation. You have to follow the rules of the SEC, the Public Company Accounting Oversight Board. So, and the state and federal, the state laws that are in effect for that particular state. Corporations are expensive to form. Even small, closely held companies, I recommend that you hire an attorney. Don't go through LegalZoom. If this is going to be your livelihood for years to come, you want to make sure it gets done right. Now, they're talking about separation of ownership and management as being a disadvantage. Earlier I said that sometimes treasury companies purchase their own stock to avoid a hostile takeover. Well, the question you have to ask is, who's management trying to protect here? Are they trying to keep their own jobs, or are they trying to do something for the benefit of the stockholder? So that's kind of a slippery slope there. Okay, so again, why would a business incorporate? Again, limited liability and the ease in transferring ownership. All right, now some of the rules for publicly traded companies, you have to prepare quarterly, usually you give quarterly, I don't want to call it an estimate, you give them, you know, your results from your first, second, third quarter. If you're traded on a public exchange, you have to be audited. And again, you have to follow the rules of the Securities and Exchange Commission and the Public Company Accounting Oversight Board. Okay, now, like I said, we're not meeting tonight, and therefore everyone has to do the go live exercise. Now, hopefully by hearing this lecture, you're able to accomplish both the go live and the homework. So anyway, I hope you have a very pleasant Memorial Day, and I'll see you next week.